Please give a heartfelt welcome to Jan Kühne and his esteemed panel.
Thanks, everybody. Thanks for being here. It's really amazing stage. It's great to have you here. How do you like your stay in Hamburg so far? Maybe I should have mentioned that I'm born and bred Hamburg native, so I ask again, how do you like your stay in Hamburg so far? Nice. Okay, so we do have a very catchy title today, The Fast and the Furious Institution Shifting Gears in the Digital Assets Area. So hopefully we can live up to that title. What we're going to do the next 35 minutes is to go through basically how institutions engage in digital assets today, where they are at the journey, and how this journey will look like in the future. We then have a little game. The reason for that game will be to illustrate how the primitives in DLT and blockchain technology diverge from the primitives we have in traditional finance. I haven't shared that with the audience and the panelists before, so it will be fun. And the main part will be obviously what is institutional DeFi, and we want to delve into that, how institutional DeFi is a concept, how that looks like, how that could look like, and how that will shape out in the future. To set the scene here a little bit, there are basically two pictures which come into mind when you think about institution adoption crypto, and we have talked about that for quite some time. One picture is that of Mr. Tutur, the illusionary giant from Jim Button and the Engine Driver. That is the giant. But when you come closer to Mr. Tutur, he gets very small, and when you're standing right in front of him, he's maybe that size. So that is Mr. Tutur, and the question is institutional DeFi Mr. Tutur? Or is it, and that is the other picture, that is the iceberg. And you know, an iceberg, the biggest part of the iceberg is not seen because it's below the waterline. So for those ocean cruisers out in the seas, ignoring the fact how big that iceberg really is, they might get in trouble. So we try with our panelists to paint that picture so you can navigate and come to your own conclusion what DeFi really is. Is it the Mr. Tutur or is it the iceberg? So very happy to have my fellow panelists here on the stage. And to start that, so you get to know our panelists a little better, I would ask you to share basically your genesis block. What piqued your interest in crypto? What really hooked you into the space? What got you maybe leaving out TradFi, except for Philipp, who was not in TradFi, but the others, like myself, who have been in TradFi before. What was that moment going into that? Maybe if I start with you, if that's okay?
Yes, sure. Hopefully people aren't bored of hearing me talk by now. But the reason that I got into crypto was the lack of innovation in TradFi. It was a time, 5 years ago now, where innovation was not at the forefront of what the banks were doing. And so I saw it as a missed opportunity. And I knew that if for anything to be done within the banking sector, it was going to take a while. And it seemed like, okay, this is a great opportunity to step away from TradFi and be involved with something innovative, something that would really make a change and move quickly. What I was working on at the time as part of my role in trading was automating trading and using AI and machine learning to do so. But that was the furthest that they had got in terms of innovation. You mentioned the word crypto. You mentioned the word Bitcoin, and they would look at you like, you needed to be on some kind of medication. So I think that ability to move away from the banks and to actually be involved in innovation and making change, moving things forward was my genesis block.
Interesting. So if I'm not mentioning, Eva is representing Figment here, head of EMEA. She was on the slot before, so probably most of you saw that part. But maybe then going to the other side, Philipp, you are co-founder and CEO of Swarm Market. You have basically an infrastructure for permission DeFi, and that is something we're interested in. Talk about that later, but first maybe you can share your genesis block as well.
Oh God, it's almost like, is there a leather sofa to lie down on? So at the time, so I had departed, much like Eva, the financial industry very early on. I said, you know, I'm done with Deutsche Bank, I'm done with Allianz Group, and I became a tech entrepreneur. I was in Palo Alto, and then was looking to acquire a company called BitTorrent, which some people might have heard of. And you know, I asked the co-founder what he's spending his time with, and he said, I'm working on a new consensus algorithm to make blockchains more eco-friendly. And I said, I had no idea what that meant, and that led sort of the first peek into the rabbit hole. And I moved Palo Alto, I moved houses, and I moved next door to this crypto community house that was called the Love Nest. And literally, I just had to take a coffee, walk next door, and be enlightened. But this was in 2015, 16, so it was an interesting time, to say the least, where there was a lot of like, almost like identity crisis of the industry, before it then became 2016, 2017, where you know, another bull market came. But yeah, never looked back. It was the fascinating piece for me was always the instant settlement piece and single source of truth. So coming from the financial industry, I was always convinced that there has to be something that happens with, you know, evolutionizing the financial markets, rather than actually looking purely into cryptocurrencies.
Interesting. Okay. Jan?
Yeah,
and to add that, co-founder and CEO as well from Crypto Finance. You're doing asset management, trading, and custody for institutional clients, and has been acquired by Deutsche Börse, I think 2 years ago, so by now part of the Deutsche Börse group.
yeah, exactly. So I come from traditional finance as well. I used to work in trading at UBS in Switzerland, in Asia, and then became the business manager of divisional head. And in that role, we did some innovation projects. We looked at new technologies like AI, like blockchain, tokenization, but crypto as well. And as Eva said, right, it's the space is just the incumbents are just too slow, and I didn't want to miss the train, so I left UBS and founded the company back then. And it was quite of a journey, a roller coaster. As you said, for you, it was the second kind of bull run. 17. I got into it 15, 16, and then left UBS early 17. And had a massive run on a lot of interest in Bitcoin. And then 18, 19 was down. And then 2021 went up again. 22, 23 is going down again. Now everyone is talking again, like in the last bear market, about tokenization, about AI. And I'm pretty sure we'll see in end of 23, maybe 24, we'll see an uptick again. And then crypto is going to be the big thing again.
Hopefully. Philipp, you're also co-founder and CEO of Li.Fi, which is basically a middle layer for dApps, providing multi-chain liquidity.
Yeah, exactly. So I'm Philipp. Compared to the others, I have a technological background. I started 20 years ago building web applications, so 2002. So I was still optimizing websites for Netscape. So it's been a while. But that way I could see the web progress in all its forms until we arrived at Web 3. So beginning 21, so actually quite recently I joined crypto, a friend of mine was calling me and invited me to join a hackathon. So I did that, and I felt thrown back to 2002. An incredible fragmented landscape, no standards. It was horrible to develop for. So great. So I saw that opportunity, and also I saw that one business model that struck my mind for years was Stripe. What Stripe was doing, Stripe was aggregating crucial financial payment infrastructure. Aggregated, abstracted away, provide a simple API, a simple brand, a beautiful brand, developer-oriented. So we thought we need to do the same thing for crypto, and that's Li.Fi. So we are aggregating anything that moves and swaps information and assets across chains, and provide one middleware where TradFi can build on. And that idea got quite successful, quite fast. So over the past 3 years, we could scale the team to 43 people, raise 23 million from international investors like Temasek, and yeah, here we are.
Great. Okay. So when we were setting the panel together sometime in April or so, since then, obviously, the backdrop for everybody talking about TradFi adoption of digital asset, that tremendously changed over the last 2 weeks with the news we got. Most notably, BlackRock applying for a spot Bitcoin ETF, and we also had Wisdom Tree and Invesco following suit, refiling their older application. We had Deutsche Bank finally announcing that they will apply for a crypto custody license. Cases, the asset servicer of SocGen and Generali, they also basically announced the same. And we had interesting Citadel coming out together with Fidelity and Schwab announcing that they will launch a crypto exchange. And that is only a few of the news we had over the last weeks. But let us unpack that, how that really relates to what we mentioned earlier. Where are we in that journey of institutional adoption? And if we talk about institutions, for the sake of the panel here, let's refer to everybody who's basically a fiduciary acting on behalf of clients' money. Let's go back in time, jump in our DeLorean and go to 2017, Jan, when you founded Crypto Finance. How could an institutional investor interact with crypto at that point of time?
Yeah, back in the days it was rather difficult. There were only a few funds or products out there. You had already GBTC, Grayscale. You had from Vontobel, by the way, a Swiss bank, Swiss private bank, had issued very early on already Bitcoin tracker certificates, Ether tracker certificates, like the ETPs, which everyone is talking about nowadays. They were, according to my knowledge, they were the first bank who have issued crypto.
Very pricey product, but yeah, there was one.
Yes. So it was really like the first way how to get into it for an asset manager, for a client, without having to care about trading, custody, and so on. But then you had already the exchanges, Bitstamp, Coinbase, Kraken. In Germany, you had Bitcoin.de and others. So, but that was rather cumbersome, and it was not an option for most of the financial institutions. That was possible for end clients. That has changed a lot. You have much more kind of financial market infrastructure, which is tailored for financial institutions. But still, I think we're very early on, because the biggest challenge we see for financial institutions is not just the trading place, the marketplace, the exchange, but it's the whole legal, regulatory risk setup and education level within the bank to get it through the different committees and get it through the boards to really launch it. But it's something where, again, Switzerland is, I would say, at the forefront. You have at least 10 banks offering crypto to their clients already. You have some international banks which have launched the crypto initiative out of Switzerland, like BBVA, for example. And you have many more already in the process or being ready to launch and offer it to the clients as well, but they're just waiting until we get a bit out of the bear market. They don't want to launch the services just before, I don't know, Binance goes under. I'm not claiming that that's going to happen, but just there's so much uncertainty yet, and you don't want to launch it on the wrong time. So I see that's really happening, and then at the same time, you have in Europe the same developments in Germany with some banks, like you mentioned, Deutsche Bank, Commerzbank is in the process as well. You have some big asset managers here in France, in Spain. So it's really happening. And I think the whole MiCA approval for the new European law was kind of a big trigger for them to decide, okay, let's move on. They had the demand already in 2021, but then, especially in 21, and as you know, a bank or an asset manager, a big corporation, they just need time. It's like 18, 24 months, sometimes 36 months to get something up and running. So they just continued during the bear market, and now they're getting ready for it.
Okay, so take a guess. Deutsche Bank announcing that they applied for crypto custody license. How long that has been in the making?
Years.
Eva, you've been in that world.
Years, for sure. I'm sure that they looked at who they could acquire, and then looked at how long it would take them to build, and then had various internal assessments of the risks of doing it themselves, the risks of outsourcing, what other players were doing in the market. I'm sure this has had very many working groups for a number of years now.
For sure. I remember some RFPs out there probably 2 or 3 years ago. So yeah, and still it will take another time until they get the final approval. So obviously these things have been in the making for quite some time. Interestingly, and then let's close the custody part, is that a lot of these major financial institutions start with a custodial offering, which is a little awkward because, I mean, the money is really on the liquidity side and not that much on the custody side. And if you see how financial industry evolves, it's that basically we see a commoditization of those things, and everybody in crypto was talking about commoditization of custody services, but still they start with the custody. Is that a testament that they believe that the volumes will go upwards? Or why is it?
I think it's the biggest blocker for them, right? They have to deal with that issue first, because the way that the banks have come to look at crypto before has been, okay, crypto is fine as long as it's not physically settled. Like, I don't want to touch that stuff. You know, it has been the reaction. They don't know how to settle, how to hold the crypto. So I think that's the biggest blocker for them to get into the digital asset space in a meaningful way. So once they're able to solve that, particularly from a regulatory perspective, whether it's doing custody themselves, using a qualified custodian, figuring out that piece to actually be able to hold crypto, you know, especially around spot crypto, any kind of intraday movements. Once they solve that, then I think a lot of doors open up, but they're dealing with the biggest problem first.
And that takes time, obviously.
Exactly.
Yeah.
And I think it's not just crypto. So custody is the foundation. You need to have custody, otherwise you can't do anything else. And it's not just crypto they're looking at tokenization use cases as well. And for that, they need, obviously, if it's on a public blockchain, they need the custody piece. So it's not just that they all want right now directly into Bitcoin, but they maybe have participated in a POC on a tokenized bond or something, so they need to store it.
I mean, the announcement from Deutsche Bank didn't mention crypto with any word. It was digital asset. If you look at the German Banking Act, there's no digital assets. It's a crypto custody license. But still, obviously, that changed. And it's probably not only because basically the word crypto has a negative connotation to some, but also because the conception of crypto is more of a digital asset and not of just a cryptocurrency. That is obviously something which is moving. But moving forward, let us go to the next part of liquidity. and with BlackRock entering the market with a BTC ETF, you could ask, is there enough liquidity in the market? And maybe, Philipp, you're on that space from the decentralized exchange side of things, but probably have that question as well. How's liquidity looking for institutional investors?
So we see more and more interest, but the problem is that it's hard to trade in this market without having too much of a price impact. In general, if you talk to a proprietary trading desk or a larger trading firm, they need at least a market cap of $500 million. And in order to trade without losing too much, or for them to have any profits out of it, because they're coming from billions, right? Like a good trading firm trades across all asset classes, so they trade in S&P 500, they also trade in crypto. You know, you have to, across options, futures, and all of that. You have to understand the one thing to understand the other, and have an advantage, like an information advantage. So if you take a look at the market caps, we have around 75 to 80 assets that have above $500 million. That's not that much compared to S&P. Then on top of that, as we speak to institutions, most traded assets are clearly just Ethereum and Bitcoin. To be fair. So this is where they all start, and this is where all the liquidity is right now. It's also just Ethereum L1, whereby we see huge outflows out of Ethereum to other L2s and sidechains and whatsoever, even L3s by now. So this is happening, but this is mostly happening for DeFi power users, for whales within crypto, for arbitrageurs and so on. And the problem is not only the lack of liquidity depth. The problem is speed of execution, the lack of order books, so that trading firms can simply use existing trading strategies like trading stop orders, stop loss orders, and all of that. And it is also a huge topic called MEV, so maximum extractable value. Now it gets technical, but there is an information asymmetry, and the lack of speed combined with that. There are third parties that can misuse large trades pretty easily. And yeah.
But talking about technical,
thing-
let's
One thing to mention, I think, what we don't know about the BlackRock filing yet, and others related to that, is whether they will allow for physical settlement or is it going to be cash settlement. That has not been resolved yet, which also then means, is this really going to have an impact on the markets as they stand? Because one of the biggest issues that the SEC took with the previous settlement functions was basically that it was all about manipulation of markets. And so where is this going to be settled now and where is it going to be traded? Is it really going to impact the real on-chain markets or related markets or not? We don't know yet. So I think it's kind of an irony that this is now like supposedly resolved, because I don't think that the foundational issues are yet.
Yeah.
But that's the biggest elephant in the room that nobody's really like highlighting at this point.
Okay. Now let's play our game, okay? I will have a pair of two terms which reflect either the TradFi world or the DLT blockchain worlds, and it's up to you to just jump in and say what's meant here and why that is important. And we have to speed this up. Looking at the watch, I start with DVP versus finality. What is meant with DVP on the one side and finality on the other side?
In the terms, you want us
don't
to...
let me...
so
Yeah,
delivery
just quickly. What is
versus
DVP?
payment,
I'm probably
finality
not...
on the blockchain, is
yeah,
that what you
blockchain,
mean?
probably the most of the
Okay.
people here know, but probably DVP, I would assume that a lot of people here don't know what DVP is, what they are.
Delivery
Philip
versus
is shaking
payment.
his head, so enlighten him. What is DVP? Just quickly. Speed this up.
So this is all the concept of centralized custodianship, right? So you basically have, a centralized digitization organization in the United States, DTCC and others, that basically they do the settlement of whatever's traded on the brokerage side. So that's a process as we know. It's T+2, maybe 3 at some times.
Come to that.
Sorry?
I will come to that. That's the next one.
So basically the other part is the immediate settlement, which the blockchain should have, right? But then the question is there's some constructs that actually then have like settlement behind the blockchain.
Okay.
So
basically, DVP is delivery versus payment. So you have these two things separated from each other. Obviously, you don't have that on blockchain. It's basically funny. Maybe we should have probed this. But the next one will be that T+2 versus T+11. What is T+2 in TradFi?
Settlement 2 days after trade.
What is
date. So
T+11 in blockchain, in Ethereum?
T+11? As in the number of blocks, the time after the trade, the initiation of
And how often is that block?
every
11 seconds. So it's T+2 days versus T+11 seconds. Catch my drift? Oh, it's okay. Next one. Post-trade reconciliation versus blockchain explorer. Eva, that's again for you or the TradFi guys here. What is a post-trade
traditionally
reconciliation?
you have like all these different players, from the brokerage to the the bank to the brokerage house to the centralized custodian to the marketplace and the other way around again. So you have like 8 parties that have to reconcile.
It's literally a mess.
It's a mess and it's very expensive too.
And you have a blockchain explorer where you just need an internet access to do that reconciliation.
And it
Great.
used to be phone calls sometimes. Someone would phone you up like, do you see this trade? No, I don't see this trade. Send a piece of paper. What about this trade?
I sent
oh,
the
yeah,
fax.
I see
Didn't
that.
you get
Exactly.
the fax? Oh, I have this Excel sheet
And each
here.
has to have a separate compliance.
He's getting it. Chargeback versus immutability. It's more from the payment side. Anyone explain quickly what a chargeback is and why you don't have that?
Well, if you have a credit card booking, you can charge it back, 10 days out.
Can you do
So
that
if you
with
buy
your
Bitcoin
Bitcoin?
for chargebacks? That's pretty good.
You can't. Cutoff time, 24/7. What is a cutoff time?
Trading hours, when you're looking at like when can things settle, when are the markets open. Obviously, market hours different depending on where and what asset class, but 24/7 with crypto.
Nice.
Which is a big problem for the banks.
Exactly.
Yes, that's
Coming
why
back
it's
to those
taking them that
slow-moving
long.
guys.
Yeah. I mean, we don't work on weekends.
There's an interesting RFP that you should look up on the internet called Project Mariana, where the Bank of International Settlement is now settling between Singapore, France, and Switzerland using smart contracts, because the opening times of cutoff times are getting in the way.
Yeah. There's these MM and LP abbreviation in traditional finance, and you have liquidity pools and liquidity provision in DeFi world? Any
What
comments?
was the first one?
LP, MM. What's an MM or an LP?
Market maker?
Yeah.
Limited partner?
You don't have market maker. What is basically the comparison in the DeFi world to a market maker? I mean, that's your
Well,
thing.
it could be the automated market maker,
Yeah.
but it's still being operated by a market maker. So,
Yeah.
or the LPs in this case.
Yeah.
Yeah, nowadays, I mean, traditional market makers are not sitting there and pushing the buttons and trade. I mean, it's automated as well, so it's a little bit, I think it's a little bit ridiculous.
I was alluding to the point that basically everybody could be a liquidity provider in the DeFi world, but you couldn't act as a market maker in the institutional world. Obviously, with Uniswap V3 and V4, it's getting more and more difficult for retail to do that, but still. Well, talking about DeFi, and as I said earlier, that concept is still very nascent. So let us look into that and start, Philip, with you, with DEXs. Li.Fi, you explain yourself as a cross-chain money Lego. Could you elaborate on that quickly, what that really means, and where basically your traction for that part comes in your business?
Yeah, let's take a look at Ethereum and what happened over the past 2-3 years. We have seen a huge influx of capital, and Ethereum got lots of traction. As a result of that, transactions like gas costs were incredibly high. So we had to learn, like we learned in the past from distributed database systems, that also the way Ethereum has to scale has to happen on multiple levels. So the newest trend is modularity, right? So the idea is of taking that node stack, what Ethereum node does right now, from taking the transactions to ordering these transactions to settling these transactions. These things are getting more and more separated, and also we need to question who should collect these things. One of these solutions is optimistic rollups, where we have centralized instances that take on all these transactions, and they do a good job in simply, like processing transactions, validating them, and then they are getting submitted to Ethereum as one. But this is only one of many, many scaling solutions. There are many buzzwords I could throw around, from intent-driven systems to shared sequencers to whatever. But in the end, the bottom line is, what we can say is infrastructure, and so also liquidity, is fragmenting. And that fragmentation is a problem for developers and for companies to actually build on crypto. So we are a cross-chain money Lego because now we have that multi-chain paradigm. We have that cross-chain paradigm. Vitalik tried to distinguish here. So an application is multi-chain if it exists on multiple chains and doesn't interact with each other. But it is cross-chain if it's supposed to interact and has knowledge of a state that is on another chain. So once that's supposed to happen, we are talking about something cross-chain. Li.Fi, what we are doing is we aggregate that fragmented liquidity, and we aggregate all the tools that allow to build cross-chain applications. For those, we need bridges. So they bridge information, they bridge assets and values from one chain to the other. And the concepts behind these bridges are very diverse. We have like 6, 7, 8 different types of cross-chain bridges that do different things, that are more or less secure, they are faster or cheaper, right? They all take different trade-offs. And we aggregate that and provide one solution with a smart order routing. And that makes us a cross-chain money Lego, because on top of that, you can build in this fragmented environment.
Okay, we probably should have a whole panel on that, but one last question. If you talk to institutions, is this only an educational conversation you have, or are they really interested in building on top of that?
That really depends. Talking to a MasterCard or a Visa, like on that level, they say, yeah, we want to be there, and we want to be there early, and we understand that we need to win the crypto industry. So they try to engage with existing DeFi power users. Those have their assets multi-chain, and they need to get out of that and be able to move freely around without having to worry how. Same for Stripe. Stripe strategy is clearly winning over developers. So they have a different go-to-market than a Visa and a MasterCard. And then if you talk to BlackRock, as mentioned, very early Ethereum, Bitcoin on just Ethereum, right? Same for Fidelity and the others.
Okay. Moving forward to staking, for crypto native, it's basically a no-brainer to decide on whether or not to stake. Obviously, you stake your asset if you're long anyway. How's the conversation with institutional clients? How's their assessment? What are they looking in? What are their concerns?
So institutions are here already. It's just at what capacity they're involved. For some of them, it's very early on. As you said earlier, they're exploring custody first if you're a tier 1 bank. The large asset managers, large VCs, large hedge funds who are not crypto native, a lot of them are already staking. They're very focused on security, on compliance, risk management, and how to integrate their world with the digital assets world. And I think that's kind of across all areas. It's not just staking, it's everything. They're trying to figure out how to merge these two things together to protect what they have already, but to make use of this new technology and these new opportunities. I think that the concept around staking for someone who holds assets, whether you're crypto native or not, is very straightforward. You have assets sitting on your balance sheet that are doing absolutely nothing for you. Stake them and earn a return. So that piece is straightforward.
It's a no-brainer, yeah.
Exactly.
Does innovation play a role in the discussion with institutions like liquid staking or something like Eigenlayer, Figment recently invested in?
Yes, I mean, I think it depends what institutions you're talking to. So your large banks, they just need a second to get their head around staking and what that involves. You say Eigenlayer, liquid staking, and they say, whoa, slow down there. Let's just go back to staking. So I think that there are some more sophisticated institutions who are looking at staking, liquid staking, structured products. Eigenlayer is obviously one of the new focuses and the buzzwords that everyone's throwing around these days.
Yes.
But for most large institutions, they have got to figure out how they get to step 1, hold the assets or enable their clients to hold assets, and then looking at staking them.
Okay. Moving forward to permission DeFi. Philipp, you have to explain what is permission DeFi in the first place and who is interested in that and why.
So I think it was right to mention actually that, aside from all the news flurry about BlackRock and ETPs and, Larry Fink from BlackRock also was quoted to say that tokenization is the future of financial markets. And I think that's slowly coming to bear, where basically all the innovation that we've put together by putting the money Legos in place, by empowering people to become market makers, suddenly can be deployed on top of financial instruments. And that requires a regulatory purview, which means you have to create technology that might reside on public infrastructure, but it has all the controls in place to actually make sure that it's in line with what financial market regulation is expecting it to be. So when we build financial regulated DeFi infrastructure, it serves 2 customer groups. One group is taking tokenized stocks and bonds and actually making them available to the wider ecosystem, either to back stable coins or build derivatives or to use for asset management. You can actually build a smart contract that is suddenly a UCITS fund, and you don't have to pay 100 basis points, which is quite revolutionary, right? But the other piece is then actually how to bring this infrastructure to actually be deployed on top of assets that just happen to be digitized, which has nothing to do with a crypto market, but it has to do with just efficiencies. Like you can have a tokenized LP position of a fund that suddenly, based on a smart contract, can be traded amongst all the fund unit holders, right? That, so far, is a really, really difficult thing to do in the financial markets. It's expensive, but it also requires a ton of paperwork to get that done. And if that's done in a digitized form, it's much more cheaper, it's more impactful, it settles immediately, so there's a lot of compelling arguments.
We went through all of them. Well, we only have 30 seconds left, so one last question. On your side, Swan Markets, Philipp, you have a research paper saying that TVL in real-world assets being tokenized will go up 10x in the next 3 years. I heard that before on the STO craze a couple of years ago. Just your take. Will it be 3 years, the 10x, or will it be more or less? Just
It's going to be way more, and we've had every year was the year of the security token, for the last 10 years. Yeah. This is not a novel concept. The thing that changed is obviously regulation and the buy-in of all the institutions. So, bear market or not, it doesn't matter because all these institutions are working on actually not to be faced with the Kodak moment where they suddenly are out of business because they forgot to actually sort of switch on the digitized infrastructure. So,
okay, awesome, just in time. Thanks a lot, everybody. Thanks for contributing to the panel. My pleasure. Thank you.